Hello again. Thank you so much for joining me. In this module, we'll be discussing lender buckets. Now, for the first section of the module, we're just going to go over a brief overview of what lender buckets are and why they're so important to your business. Let's get started. So what are lender buckets? Well, lender buckets, that's a term that I actually coined to help me explain how I place loans with the right lenders. So let's jump into just a quick definition of what it means. So lender buckets are essentially groups of 2 to 3 nationwide lenders who you place your loans with on a consistent basis. Now, the idea here is that you're able to categorize loans or scenarios as they come into you. So when you get a loan, you know the submission process of these lenders, the lenders that are in your buckets. You know their guidelines. So you know them like the back of your hand. You know what questions to ask the borrowers, and you know the results. You know how the lenders in your lender buckets are going to produce. What kind of results they're going to produce. What kind of fruit are they bearing on their trees? Now, in essence, though, they are your menu items. So we're going to go over an analogy. We're going to kind of play with the restaurant analogy through the rest of this section. So you'll see when we get into it. So why do we need lender buckets? That's a good question. Let's just assume that you bought a IHOP restaurant. It's an IHOP franchise. You serve breakfast, that's your specialty, and you also got a few other menu items that people like to purchase. Now, let's pretend that a customer or potential customer came into your door and said, hey, I like what you have, but I would really like a Chick-fil-A sandwich. And so the right answer as someone working behind the desk would say, well, that's a great request. However, we don't provide Chick-fil-A sandwiches. So you'd have to go to Chick-fil-A for that, but we can give you this. But the big mistake that a lot of commercial loan brokers make is when a scenario comes to their door, if they don't have the lender resources in place, they still say yes. They'll say yes to scenarios and to deals that they aren't prepared to take on. So the thing that happens with that is if you say yes to, let's say you own an IHOP, you say yes to going and getting a Chick-fil-A sandwich or a Whopper from Burger King, what's going to happen is you're going to waste a lot of time. So you're going to have to close up shop at your IHOP restaurant. You're going to have to jump in the car, go to Chick-fil-A or Burger King and bring back the sandwich. Now, the problem is you just spent all that time finding the right food for your customer, right? So that's going to create a real bad experience for your borrower. You're also going to be wasting your resources that you could be using on qualified borrowers. However, you're using them on borrowers that don't necessarily qualify for what you have to provide. And then finally, you're obviously going to suffer in your reputation because by the time that sandwich gets to the customer, it may have been 20, 30 minutes. The customer's frustrated. The food is probably cold and doesn't taste as good as it should. And who knows, you might not even be able to give them what they ordered. So the idea is to make sure that you're prepared and able to market a certain kind of product. And when a borrower comes into you, to be able to pre-qualify them for the right product. So you're saving them time, you're saving them resources and your resources, and you're providing a good experience. Now, the big mistake is chasing deals that will never fund. So this is just a quick example. Let's say someone came into your restaurant and they asked for a Martian milkshake. Now, you say you're the kind of restaurant who doesn't want to deny anybody that comes in the door. So you say, yes, I can get you a Martian milkshake. So you leave and you spend the rest of your life and the rest of your money trying to search down this Martian milkshake. Sure, the borrower might be willing to spend $1 million to get this milkshake. They'll give you $1 million. However, the problem is a Martian milkshake doesn't exist. And that's the big mistake we're trying to avoid by establishing our lender buckets and who we have in our kitchen instead of saying yes to every deal and going out and trying to find the resources and the lenders for that deal that just might never fund. There are some scenarios that are unfundable. And that's the big thing that you're going to learn as you broker commercial real estate loans, is that a lot of deals just are unfundable. So it's best to stick with your box that you establish. So throughout this module and throughout the next few sections, we're going to establish what a lender bucket is, what lender buckets you should be using. And then in the rest of the module, we're going to actually talk about how to establish those lender relationships and understand their guidelines. And final point, obviously, the big idea is to be prepared to fund the deal that's coming into you. Now, let's just talk about the lender buckets that exist. We're going to be going over each one of these lender buckets in the module. So your first lender bucket is going to be your fix and flip requests. So borrowers that come in, they are typical fix and flippers, and they want a loan to purchase a property and rehab it. So that's your typical fix and flip loan. This is going to be probably, I don't know, it depends on where you're marketing, but it's going to be a large chunk of your loan request that comes in, and there are plenty of lenders that will provide fix and flip loans. Your second bucket is going to be your commercial bridge loan. So these are properties that are commercial properties that are unoccupiable and don't qualify for permanent financing. So what you do is you give them a bridge loan, which allows them to stabilize the asset and convert into a permanent financing. That's why bridge actually stands for bridging the gap into permanent financing. Your third lender bucket is going to be permanent financing. So these are your buildings that are 100% occupied, or let's just say 75% occupied, and the borrower seeking permanent financing. So that 30-year loan that a typical bridge is looking to move people into. So you're moving people into this permanent financing product. And then finally, your last bucket is your specialty financing. So these are properties that are special use, such as golf courses, or maybe churches, or a bowling alley, for example. You're also going to kind of bundle in your ground up construction deals. This is a specialty style financing. So ultimately, there's 4 buckets. And again, the idea is to establish kind of like a menu for your lending business. So for example, your breakfast menu is your fix and flip. You want to establish about 2 to 3 lenders for each bucket. So on your breakfast menu, you might serve pancakes, eggs, and bacon. You got your 2 to 3 lenders, but obviously it's your lender guidelines. And so the idea is you're going to have the right questions to ask, and you're going to be prepared to serve your borrower in the right way. We can call your commercial bridge your lunch, right? Same thing here. Maybe you got a dinner menu on your permanent financing, and then special financing is kind of like dessert. You don't do it all the time, but you have those sweet products on the back end. So again, with your lender buckets, we're establishing 2, maybe 3 lenders for each bucket. So when a borrower comes in the door, you're prepared to do that deal. And if it doesn't fit in your lender bucket, it's best just to walk away and try to find the next deal. And we'll get more into that as we continue on through the module. Now, the end result of module 2, and I talked about this a little bit earlier, is number 1, to gain a deep understanding of each lending bucket and the lenders within that bucket. Number 2 is to establish that list of 1 to 3 lenders. So by the end of module 2, you should have an actual list, a physical list, 1 to 3 lenders in this case. And sometimes you're going to want to just use 1 for a lender bucket, just so you don't get confused, and it makes it easier on your marketing side. But you could have 2, maybe 3 lenders for each bucket. And then finally, by the end of module 2, you will have chosen 1 bucket as your primary moneymaker. Just like in those last examples, we had people. Some franchises serve mostly lunch, like McDonald's. You go there for lunch. You can also do breakfast, but they're a lunch place. They do those sandwiches. Same with Chick-fil-A. That's a lunch place. But when you go to IHOP, their specialty is breakfast. Sure, they have the other options, but it's a breakfast specialty, right? So we want to make one of those buckets your primary moneymaker, and the other buckets are kind of like more of your value adds. I want to thank you so much for joining me for this section of the Lender Buckets module. Now let's get ready for the next section, where we're going to be discussing the first bucket, which is your fix and flip bucket. Now let's get to it. Talk soon.